Earnings season is underway and Wall Street is taking a hit on this Tuesday. The equity averages are off about 1% on the session, and we're seeing mixed trading for oil as well as the U.S. currency. Joining me now is Tim Anderson of TJM Investments. Tim, thank you so much for joining me today. Well, in today's trading session, we are keeping an eye on the equity markets. We're seeing crude oil lower after yesterday's tick higher, about $51 a barrel. But we're also seeing the U.S. currency well elevated. So what do you make of the price action so far?
Well, it's certainly the reverse of what we saw yesterday, and even probably a more convicted move. This has been a very, very low conviction market for the last few weeks. We haven't really had follow through in one direction or another from any of these 100-point moves we've seen in the Dow or double-digit moves in the S&P. But the other thing that's going on today also is that bonds are being sold again. The British gilt 10-year is above 1% for the first time since Brexit, and our 10-year is above 1.75%, which has been a support level for quite a while. So that's got the defensive stocks for sale again. And unlike a lot of the rotation that we saw over the last couple of weeks, it's not really that the banks or oil or some of the material stocks are in the green. Right now, we'll have to see how long it holds. There's just few places to hide in today's market.
Tim, you brought up a bunch of important points, but we also have to keep in mind we're in the final quarter of this year. It is an election year, and we do have Fed rate hike expectations being baked in right now. So what should investors watch out for?
Right. Well, I think that any break of the current level would be something that even a lot of portfolio managers that aren't necessarily technical analysis by training are going to watch that very carefully, because as of yesterday, we were within maybe 1.5% of the all-time high. We got through September, which is typically a treacherous month. We in very good shape. We finished the third quarter with certainly respectable single-digit returns, and a lot of that's been held up by very, very low interest rates, and we've also had a very moderate at best IPO calendar. This is the time of year when a lot of firms really try to get as many IPOs that are in their pipeline completed before the end of the year, because that adds to their final year's numbers. And we've had some IPOs, but certainly not to the extent that we've seen in the past, particularly with a market within a couple of points of an all-time high. And what would typically happen, of course, is that if you have a lot of IPOs coming to market, that competes for institutional cash with the secondary market.
And Tim, before I let you go, I do want to ask you about central banks. So we do have several central banks we're paying attention to, including the Fed, but we have negative interest rates overseas. So how should we be factoring all of that in as we head into year end?
Well, I think you have a lot fewer negative interest rates in the Eurozone and in Japan than we had months ago, and it seems that those central banks, the Bank of Japan and the ECB, are trying to get away from that. So that I think has been part of the reason why our rates have moved up a little bit. Also, some of our inflation data has moved up a little bit. I think there's probably it seems there's a 65% probability that the Fed will hike in December. Even Charlie Evans, who's among the Fed regional presidents, is pretty much the ultimate rate dove, was talking about it being probably time for a rate hike in the near future. And it'll be interesting to see how well the market accepts that, because it's probably going to happen in December.
Well, Tim, we still have the election to get through, so we'll see what happens in the coming weeks. Thank you so much for joining me today.
Sure, anytime.